If you want to build wealth and retire early without stressing about picking stocks, this video is for you, because today we'll be breaking down Warren Buffett's favorite investment of all time, index funds. And after 24 years of investing, it's 100% my favorite way to invest. This is known to be the easiest, most reliable way to grow your money, even if you know absolutely nothing about the stock market. By the end of this video, you'll know exactly what an index fund is, how it works, the pros and cons, and step by step how to buy your first index fund. Chapter 1, what is an index fund? Let's start with the basics. When you buy a single stock like Tesco or AstraZeneca, you're buying one company. If that company goes well, your investment grows. If it crashes, your money goes with it. But when you buy an index fund, you're buying a basket of many companies all at once. For example, a FTSE 100 index fund here in the UK holds the 100 biggest companies on the London Stock Exchange, names like BP, Shell, HSBC and Unilever. So instead of betting on one company, you're investing in the entire UK economy. And there are global index funds also, where you're probably better off investing at this moment in time, to be honest, like an S&P 500 fund, which tracks the 500 largest companies in the US, or an all-world fund that includes thousands of companies worldwide. When you invest, you're basically saying, I want to own a tiny piece of hundreds or even thousands of companies that drive the world economy. Simple, powerful, and completely passive. If you are serious about investing, hit the subscribe button so we can build wealth together. Chapter 2, how index funds work. Index funds don't try to beat the market, they just match it. So if the FTSE 100 goes up 5%, your fund goes up 5%. If it drops 5%, your fund drops as well. Over the long term, the global stock market has returned about 8 to 10% per year on average. That means if you invest £1,000, it could grow to 2,000 in roughly 7 years, without you lifting a finger. If you invest £500 per month for 30 years, you're talking over £1 million. And most of that comes from compound interest. Despite what some people think, this isn't gambling. It's owning small slices of real, profitable companies that pay dividends, grow revenue, and drive the world economy. And as the saying goes, it's not about timing the market, it's about time in the market. As always, nothing in this video should be taken as financial advice, and the full disclaimer can be found below in the description. Chapter 3, the pros of index funds. 1, low risk compared to single stocks, because your money's spread across hundreds of companies or thousands. One bad company can't wipe you out. 2, long-term growth. The stock market has always gone up over time, despite wars, recessions and pandemics. If you stay invested, history shows your wealth compounds. 3, truly passive. You don't have to research companies, read balance sheets or check charts. Just buy, hold and let the world's biggest businesses work for you. 4, low fees. Index funds are extremely cheap. Some cost as little as 0.07% a year. That's 70 pence per thousand invested. Chapter 4, the cons of index funds. 1, you'll never beat the market. If you invest in the FTSE 100, you'll get the FTSE 100's return. Nothing more. You won't double your money overnight like a lucky crypto investor, for example. 2, it's slow and boring. There's no thrill, no drama, just steady, consistent growth. And that's exactly what makes it powerful. 3, short-term volatility. Yes, the market goes up long term, but in the short term, it can drop 20 or even 30%. It's normal. And if you keep investing through the dips, those are actually buying opportunities when you look into it. Chapter 5, choosing the right index fund. Now, how do you actually pick one? Here are the 4 things to check before you buy. 1, the index it tracks. Decide what you want exposure to. UK companies, FTSE 100 or FTSE All Share. US companies, the SP 500. Global diversification. FTSE Global All Cap or Vanguard-like strategy. 2, the ongoing fee. Keep it below 0.2% if possible. The less you pay in fees, the more you keep in returns. 3, platform or broker in the UK. You can invest through platforms like Vanguard, Free Trade, Trading 212, AJ Bell or Hargreaves and Lansdowne. These are like your investment account providers. 4, use a tax-free wrapper. If you're investing in the UK, always use a stocks and shares ISA. That way you'll never pay capital gains tax or income tax on your profits. You can invest up to 20,000 per year completely tax-free. And if you're investing for retirement, use a SIP, self-invested personal pension. You'll get tax relief on your contributions. Chapter 6, how to buy an index fund, step by step. Let's walk through it step by step. 1, go to Vanguard, for example. 2, open a stocks and shares ISA. 3, choose your fund. For example, the Vanguard FTSE Global All Cap Index Fund. 4, decide how much you want to invest. Let's say £100 to start. 5, select reinvest dividends. This means all your profits automatically buy you more shares, speeding up growth. 6, click confirm. That's it. You've just bought your first index fund. And the best part, you can set up an automatic investment each month. £100, £200, whatever fits your budget, and let compound interest do the heavy lifting. Chapter 7, when should you sell? Ideally, you don't. The magic of index investing is long-term compounding. Every time you sell, you interrupt that process. Instead, think in decades, not months. Most people can't do this and will continue to chase quick, easy money. Like me before 2018, before I decided I needed financial education to help me build wealth and hit my financial goals. If you stay invested for 10, 20, even 30 years, your money grows exponentially. As the saying goes, the stock market is a device for transferring money from the impatient to the patient. Chapter 8, real example, the power of staying invested. Let's say you invest £250 a month into a global index fund that averages 10% returns per year. After 10 years, you get 51,000. 20 years, it's a big jump to 189k. 30 years, you end up with a huge 565k, all from simply setting up a direct debit and doing pretty much nothing. That's the power of boring, consistent investing. Let me give you a personal story to drive home the importance of investing. I invested £500 a month into a stocks and shares ISA at 18 for 6 months, but stopped and spent all of my money on a lad's holiday to Ibiza. Huge mistake. This was down to a lack of financial education. Let's say I was taught about things like compound interest at school. I know I would have invested from the age of 18 to now, so that's a full 24 years. If I got average returns of 10%, that would mean I would be sat on £594,000. And looking at that huge amount, 450,000 is made up of interest earned. This is again the power of consistent investing in index fund, the power of compound interest. Summary. Index funds are the foundation for long-term wealth. They are set and forget, stress-free, diversified. They're simple, cheap, and they work. You don't need to chase meme stocks or gamble on crypto. Just own the market and let time do the rest. This video has given you all the info you need to understand exactly what index funds are. But you now need to fully understand how to buy them. How to buy index fund is the next video in this playlist, all about index funds and how to retire early so you can live life on your own terms. And remember, the best time to start was 10 years ago. The second best time is today.